I didn't expect the new orders component in the ISM to be as weak as it was. It's a leading index. It's one of the 10 series that's used in the index leading indicators. It fell 11 points. It's at 51. And here's the key thing to remember. These figures are early month survey. In other words, they captured December 1 up to maybe the second, third week at most. So the data don't fully reflect the further tightening in conditions late in December. And you have to think, unless there's a real meaningful rally soon, new orders are going below 50, which means the ISM is going below 50. And when that happens, you do worry about recession.
Yeah, Joe, Powell speaks tomorrow.
Well, yeah, and he's got a lot to think about. But how do we explain? Is it the impact of the tariffs, which if you read through the ISM, all the respondents talk about the impacts of tariffs, or is it actual growth slowing? Because the ADP number was strong.
Sure.
You look for the unemployment expectations tomorrow. I think consensus is 180.
Could be higher.
Right. No one's really moving their number lower. So is it just the impact of the tariffs, or is it growth slowing?
No, Joe, it's the Fed. It's the tightening in liquidity. It's the fact, as you know, virtually all asset classes last year had a horrible year. The low prior to the fourth quarter was in February, well before all the tariff stuff came into focus. This is a Fed, in my opinion, Fed-engineered story. And if you look at the high in the equity market, was when Powell was hawkish on October 3rd, and he really fumbled the ball in December. So it's really, to me, more about the Fed. When I looked at the ISM data today, the new export orders is above 50. It's been basically flat for 3 months. It's an issue, but my guess is everybody's using that as an excuse. And if that's the case and the Fed is hawkish, you're supposed to sell rallies because the bear market's just beginning.
So, Jenny, we're going to hear, as we said, from Fed Chair Jay Powell tomorrow. He better say what the market wants him to, or this 400 or 677-point decline could look even uglier after the data today.
Right. So here's my question for you, Joe, which is, if a 2.5% Fed funds rate and a $4 trillion balance sheet is not the appropriate strategy for an economy with 2% inflation and 3.7% unemployment, what do you think is the right strategy?
So I did on CNBC a year ago. I said, look, the Fed should stop at 2%. Cap rates at 2%, take all your hikes out, let the balance sheet gradually roll off to get some price discovery in the market, try to steepen the curve. So if you look at the Fed, historically they haven't gone a whole lot. But when you're the only central bank globally that's hiking and the dollar's appreciated as much as it has, especially against the EM currencies, the Fed should just cease, desist, repent, back away, and try to run the economy hot. And they may not be successful, and the asset bubbles may grow more. But to try to get a soft landing in both the equity market and the economy, boy, good luck with that.
Doc, if the Fed goes full-on dovish, is that enough? Given what's going on with the trade fight with China.
Is
it enough to...
Where Joe's been spot on here, Judge, is that the moves that the Fed has made have really caused the dollar to be as strong as it was against all odds last year. Nobody was really calling for that, Joe. And yet, because of the Fed moves, the dollar just zoomed. That's one of the things that Tim Cook cited last night when he talked about, what's going on as far as demand. And he won't be the only CEO that talks about a strong dollar being an impediment. That is a significant impediment. So your question, is a dovish Fed enough to get us to turn around?
This is a whole Fed problem.
Not all by itself,
right,
but over a 6-month period, yes. But, unfortunately, they really were on autopilot. All of this that we're talking about right now, including the ISM, these are supposed to be the brightest men and women in the room. 700 economists there. And they're all dead wrong on this ISM, the first reading of this ISM. Are you kidding me? That's why they shouldn't have moved in December, Judge.
Well, we keep talking about a potential policy mistake. There's a very good chance that they already made the mistake.
Yes.
So being dovish isn't enough. It's how do you reverse the mistake? And that's going to be the challenge for them.
That's a good point, Joe. But again, the sooner you move, the old stitch in time saves 9, the less damage you do. If you wait for confirmation in the data, which oftentimes is lagging, it's too late. It's really too late.